Welcome back to The Explainer. So, if you're staring at your portfolio right now and just kind of scratching your head, well, believe me, you are definitely not alone. I mean, 2025 really felt like the global economy was playing this giant, high-stakes game of financial chicken. And as we step fully into 2026, the signals, they're only getting more chaotic. So our goal today is to cut right through all that noise and decipher exactly what the heck is happening in the markets right now.
Okay, let's dive into this roadmap. First up, we're looking at the 2026 setup. Then, number 2, the bear case. 3, the bull case. And finally, 4, the really tricky one, the sideways market.
Section 1. The 2026 setup, financial chicken.
So 2025 basically left absolutely everyone guessing, perfectly capturing this wild split reality. On one side, you've got bears screaming from the rooftops about an imminent recession. But then, on the exact opposite end, bulls are out there scooping up AI stocks like they're the last pack of Pokemon cards on the shelf. The disconnect has just been wild.
All right, Section 2, the bear case. Extreme valuations.
47 times. That is NVIDIA's massive price-to-earnings multiple. And it really highlights just how fast AI valuations have stretched miles beyond traditional fundamentals. But, the stretch definitely doesn't stop with just one company.
Check this out. 400 times earnings. That is where Palantir has been sitting. And this is right about where the rapid-fire valuation shock really sets in for analysts who prefer, actual historical norms. And then it hits a peak extreme. Datadog at a staggering 430 times earnings. The whole bear argument here is pretty simple. When you're buying at these kinds of multiples, you aren't really investing based on current fundamentals anymore. You are quite literally just pre-ordering hope. And this brilliantly illustrates the broader impact of those tech multiples. The historical average PE for the S&P 500 is right around 16. But currently, we are sitting near 31. A tiny handful of these high-flying AI stocks are literally dragging the entire index up to nearly double its historical average. To really understand how top-heavy this has all become, just remember that the S&P 500 is supposed to represent broad diversification, right? But the magnificent 7 tech giants now make up over 35% of the index's total market cap. It is exactly like that group project you had in high school where, 2 people do absolutely all of the work, but everyone else still gets the credit.
To put a finer point on it, in just the first 3 quarters of 2025 alone, those 7 companies generated over 41% of the S&P 500's total returns. And here is the hidden structural danger that the bears always point to: passive investing. Since most index funds are market cap weighted, as these tech giants grow, they eat up a larger and larger share of the index. So when new money flows in, it just automatically buys even more of those exact same giants. It's this beautiful feedback loop, right up until it isn't. A stumble in just a few tech stocks could seriously drag down your supposedly diversified portfolio.
Plus, history tells us a drop isn't just possible, it's statistically expected. Since 1954, the market has averaged a 10% pullback about once every 3 years. Market nerds like to call this a reversion to the mean. Simply put, corrections are just a normal, healthy part of the market cycle after years of outsized returns.
So, the crucial point is perfectly summarized by this famous quote from the economist John Maynard Keynes: "Markets can remain irrational longer than you can remain solvent." You see, even if the bears are 100% right about the crazy valuations and the unhealthy market concentration, if you bet against the market too early, well, being right too early is completely indistinguishable from being wrong.
Okay, let's flip it. Section 3, the bull case, unstoppable forces. It starts right here with the Federal Reserve. The bulls are clinging to a massive fundamental tailwind. 2025 ended with the Fed delivering 3 consecutive 25 basis point cuts, and the median expectation heading into 2026 is at least 1 additional cut. Bottom line, the Fed is actively lowering interest rates.
Let's move to and see how this builds logically into a super powerful chain reaction. Step 1, lower rates. Step 2, cheaper capital for businesses and consumers. And step 3, this looser liquidity makes investors perfectly comfortable paying a huge premium for future earnings. That is exactly how markets can just keep grinding higher, even if the underlying economic data feels kind of mixed. But wait, the bulls aren't just looking at monetary policy, they're looking at fiscal policy too. We are dealing with an over $1 trillion annual U.S. deficit. Now, whatever you might think of the long-term consequences of that mountain of debt, in the short term, massive government spending pumps money directly into the system. It acts as a highly impactful prop that supports consumer demand and keeps those corporate revenues looking high.
Which brings us to Section 4, the sideways market, the gray area.
We really have to ask this pivotal question. What happens when the fundamental tailwinds of rate cuts and government spending collide head-on with the real structural risks of stretched valuations and extreme concentration? Because, let's be real, markets rarely move in clean, predictable lines when massive forces clash like this.
Now, what's really interesting about this slide is that it shows the eerie scenario almost nobody actually positions for. In a sideways market, the headlines flip basically every 2 weeks. Rallies stall out just as you start feeling confident again. Dips feel completely terrifying but never actually bring real solid buying opportunities. Instead of picking a clear direction, capital simply rotates endlessly between different asset classes. This choppy middle ground is incredibly dangerous because it quietly destroys portfolios through pure impatience.
So, as we wrap up today's explainer, I really want to leave you with a challenge. You've seen the data, you know the arguments on both sides. When you look at the landscape ahead, what's your conclusion? Will 2026 be the year things finally break? Will those unstoppable forces cause us to just rally higher? Or are we trapped in that agonizing sideways grind? Take this framework, apply it to what you're seeing out there every day, and decide where you stand. Thanks for joining me to figure this all out and keep learning.